Good afternoon and welcome to this webinar with Castings PLC, hosted by Yellowstone Advisory. We're delighted to have with us Adam Vicary, the CEO, and Steve Mant, the Finance Director. And I'd now like to hand over to Adam to start today's presentation.
Hopefully you can all see the screen, and good afternoon. This is a fairly brief presentation on the year that's just finished here at Castings PLC. For some of you who are already shareholders, you may know a bit more about the history of the company, but I'll go through things, the history a bit fairly quickly and some background as well. So the business started in what was and still is regarded as the Black Country of the West Midlands in Warsaw in 1835, and production was consolidated on this site here in Brown Hills in the late 60s, and the original site was closed. William Lee, which is a foundry business, was acquired in 91, which is based up in Drumfield, halfway between Chesterfield and Sheffield. The machine shop was acquired in 96. We built a new foundry at our William Lee site in 2009 and embarked on a major automation and robotic implementation from 2016, and still progressing in that area. So the three sites, I'm based here at our Brown Hill site, foundry business. Drumfield is a slightly bigger operation, and our machine shop is also here in Brown. It's literally over the road from our site here in Brown Hills. What do we do? So we're an iron foundry. We melt iron in electric furnaces at about 1,600 degrees, and then we pour them into sand molds that make a shape, or a casting as we call it, at about 1,450 degrees, and then the part goes for initial processing and then either machining at our facilities or also at our customers' facilities or other machine shops and finishing shop businesses. So headline results, our dispatch weight was over 53,000 tonnes for the first time in quite a few years. Revenue was up strongly, not all as a result of, but quite largely as a result of our energy-related surcharges, which were implemented from October when our old energy contract ended and our new one started. Profits improved, and the strength of the balance sheet and the belief of the directors in the business resulted in an improved dividend and a special dividend. A bit more detail. So the growth in sales tonnes was 6.6%. We are currently operating at or near capacity. Our mix of work machined was a record high, which reinforces our investment in that business. We had significant labour and other general cost rises within the year, which we have passed on, although those increases weren't passed on until April just gone. So we had quite a lot of the cost in the last financial year, but the price improvement is in this financial year. Energy surcharges recovered the energy cost, which was an increase of 30 million on an annualized basis, and that was all been recovered, but unfortunately at nil margin, so that had a dilutive effect on the margin percentage. Pleased to report the machine shop returned to profit. Good volume. We've improved the pricing, and also the new engine platforms you may have heard us banging on about in the past are now very much in production, and the products we make for those parts have a better margin, particularly in the machining environment. We got ourselves in a bit of a pickle during the year with production overloads in certain areas, so we had to rebalance that with some extra tooling costs, which probably was the thick end of 500,000 and a similar amount of disruption, but that's all behind us now. And demand from the US continues to be strong, and in our non-truck business We've also seen some growth and other opportunities in wind energy, which is cable protection devices, truck trailer braking and truck trailer coupling products. So I'll just ask Steve to give you a bit more flavour on the financial side of the year that's just finished.
Thanks, Adam, and good afternoon, everyone. So the first slide here just sets out some key performance metrics for the group for the last 5 years, which includes the COVID impact in 2021, which you can see there in the sort of middle-ish column. So group revenue of just over 201 million, which is 35% increase on the prior year. Of that increase, approximately 10% is due to volume and mix, and the remainder is due to electricity and other cost surcharges being passed on. Operating profit up 36% at 16.4 million at a margin of 8.1%, which is consistent with the prior year. But if you remove the dilutionary impact of electricity surcharges, then that margin would be closer to 8.8%. Return on capital employed of 17% for the group, which is at the highest level since 2016, and we'd anticipate that to increase in the current year based on consensus numbers in the market. Continued our progressive dividend policy and increased the final dividend by 7.5%, which brings the total increase in the total dividend of 6.9% with an overall dividend of 17.35 pence. With free cash flow of 13.7 million, year-end cash position of 35.5, and the confidence that we had in the demand visibility in the short term, the board decided to declare a special dividend as well as that increase to the ordinary. So a special dividend of 15 pence, which is the same level as the prior year. The consensus numbers in the market for the current year are for a profit before tax of over 19 million and cash of around 40 million at March 24. So obviously it's difficult to measure the performance of the business against revenue metrics because you've got all the surcharges being passed on. So this slide just sets out what a profit per tonne sold, so removing those impacts. And it's pleasing to report that the profit before tax per tonne sold of over £300 a tonne, which is the highest it's been for the last 5 or 6 years, and heading back to those higher levels that you can see on the slide of 2012 to 2016. And again, on those consensus numbers, we'd expect this metric to be up at the 350 plus for the current year. Talked about the progressive dividend policy. So this slide just sets out the last 23 years, I think it is, and shows the dividend growth that we've had each year, apart from the financial crisis, 2 years in there. We look at the business as 2 segments, the foundry segment and the machining segment. So this slide sets out the foundry segmental results, which shows external revenue increasing by 37% to 199 million. The weight of castings sold reflects the cyclicality of the heavy truck sector, which is obviously where 75% of our revenue comes from, and we're currently in a period of very high demand in that sector. Average selling price shows there a 28.1% increase, again distorted by surcharges, so difficult to compare year on year. The overall result for the foundry segment was 16.3 million profit compared to 13.1 in the prior year, which represents a slight reduction to the margin at 7.3%. But again, if you strip out the dilutionary impact of those electricity surcharges, it's broadly comparable to the prior year. So again, the machining segment is set out on this slide for the last 5 years. CNC is very much focused on serving the foundry customers. So a revenue line of 2 to 3 million, whilst it looks like it's down on the 2019, 2020 levels, that is a deliberate focus and strategic choice of the group to focus on that internal work. Q4 for CNC was particularly strong, Higher volumes and price increases were bedded in, and that company generated a profit margin of around 7% for that quarter. That is pleasing to report has continued in the current financial year as well, but produced a segmental result of just in the black for the first time in 6 years. So that's pleasing, and as I say, that trend is continuing in the current year. The business generated cash of 1.3 million, which is slightly lower than the prior year, mainly due to the working capital increase associated around those price increases. Obviously, the longer credit terms offered to customers versus the terms that we have to pay those increased costs mean that there's a slight drag on working capital. And then CapEx of broadly consistent with last year at just over the £1 million level. That is the sort of level that we see the business, 1 million to 2 million going forward, CapEx at those sort of levels. And then a cash flow statement for the year. So obviously profit before tax of 13.8 million, significantly up on the prior year. Depreciation of 8.5 or 8.6 million is consistent and around the same sort of levels over the 5 years shown on that chart. And we'd expect that to continue at those sorts of levels for the next couple of years, and then do see a slight step change of maybe 1.5 million to 2 million coming out. Working capital, again, as I mentioned on the CNC slide, that outflow around the cost increases and passing those on. So in the current year, with us being at broadly capacity, you wouldn't expect much of a further outflow associated with that in the current year. Group-wide CapEx 6.2 million, so up slightly on the prior year, but again 5 to 6 million, subject to any expansion in capacity or anything like that. The 5 to 6 million is about the level that we'd expect to see it at. So generated a free cash flow of 13.5 million for the year, which was used to pay the ordinary and supplementary dividends. So overall, a broadly neutral cash position for the year.
In terms of what the business is and its market, we are a business that supplies, as I've said, iron castings, in particularly into heavy truck. So these are the large trucks you see on the road, particularly taking containers and very heavy goods. Our automotive business has actually been reducing, but we're not really chasing any automotive work. We have a little bit of work for Toyota here in Derbyshire, and a little bit for JLR. And the other business is made up of wind energy and trailer couplings, trailer braking, and a little bit of traditional agriculture that we've always supplied. We don't have much in the UK. The vast majority of our business is into Europe, and we set an agency up in America a few years ago now, and we benefited from that, although we're sort of holding off from a sales push in America at the moment because we are pretty much at the ceiling of our capacity. Some of our customers, some of them I guess you'd call household names, some of them are probably not too familiar with you, but our biggest customers are Scania, Volvo, Daimler and DAF. DAF is part of the PACCAR group. And if you want to see what's going on with castings business, if you look at the European heavy truck registrations, we follow this pretty closely. And as you see, the Volvo estimate for 23 is almost back to 29. I think it may end up exceeding 2019 when we actually see the real figures. And all of our truck customers are, if you read their communications, are saying that they are building more trucks per day than they ever have, and they're also looking at increases in the autumn. That just gives you a little bit of a flavour of seasonality that we see here, but perhaps more importantly, the foundry sales weight along the top you can see has improved significantly in 23, and I'm anticipating that unless the world falls apart, we'll do more than 55,000 in the year we've just entered into. So a breakdown of our big customers. A is Scania, 25%, Volvo, Daimler and DAF. So in terms of the overall sort of highlights, we have seen pent-up truck demand, probably driven at least in part to the issues that they had with semiconductors in 21 and into the early part of 22. We've seen the benefit of our the new engine platforms that we have with both Scania and Volvo, where we have greater content and higher margin products. We have a very good growth potential in the States, other than we've got capacity constraints, and there's some other nice business coming through. We're continuing our quest to improve automation within the foundry and machining business with further robotic investments. We're just embarking on a artificial intelligence system for inspecting product, albeit it's a small scale pilot, so we're quite excited that we can bring that into being and help supplement the automation that we're currently engaged in. Our wage increases went up by about 10% across the group, and which was obviously quite steep, but if nothing else, it's put the delta back in on ourselves and supermarkets and white van man, so we are finding recruitment issues are pretty much behind us. We've already alluded to the energy contract, which was probably the biggest event during the year, which ended in September, and our annualized bill went from around about 11 million to just over 40 million, and it would have been higher if it wasn't for the government's cap on high energy users. So we've seen a small reduction in the year that we're just in, but the wider market has been a much bigger reduction, but we never saw the peaks in the winter period because we had the government cap. I've already mentioned that we had some other inflationary pressures in the year, which we've passed on with the price increase from the 1st of April. So we are a recycling type business. We buy steel scrap from other processes and we melt it. We only use electric melting on this site, unlike quite a number of our competitors on the continent that are still using coal-based products. We have 100% Rego-backed supply of energy, and our gas, which we don't use too much of, will also be a green contract when we sign that in October. We've already signed it, actually. It starts in October 23. And some other ongoing initiatives. Our machine shop, which has 120 machine tools, each one fitted with a refrigeration unit. We have started a centralization program, which is far more efficient. We're probably a third of our way through that program. We're also looking at a sand reclamation project, which will reduce the amount that goes to landfill. Hopefully we've done most of the technical work. We're hoping to bring that into being later in this year. And we offer to our customers the ability to do further processing that they may or may not want us to do, but they often have to go to other parts of Europe to be done. And leveraging our balance sheet, we're offering other processes so we can reduce the carbon miles. So in summary, on the short to medium term view, we are extremely busy. We're going to stay busy until at least the end of the calendar year. Our customers are forecasting increases next year, but that's a little way off for us to hang our hat on. The Scania engine will be also sourced by MAN from 2024. So the products that we supply to that will increase by the number of truck engines that MAN purchase. We can already see that that's going to be 50 to 60 tons a week. Continuing on our automation, the issues we had with production rebalancing has been resolved, and we're well placed with our surcharges on commodities, and we have had to move our base prices. Continuing the investment into automation, and from an M&A perspective, we're still sniffing around aluminium. Maybe something might come off, maybe something might, but we're still interested in that market, as we are greater value add, which kind of complements ourselves with the reduction in carbon miles. So longer term, if you'd have asked me 3 years ago that the cloud on the horizon that was the battery electric vehicle is now a cloud that's much further away than I initially envisaged. And we're starting to see a lot more opportunities for supply of products that we make and the type of products we make into that battery electric vehicle market. But we're unable to capitalize on that at the moment because we are so busy. And to that end, we have started the planning process of putting a new line in, which we may or may not do, depending on what our customers say to us when we speak to them later this year, and whether or not we can future-proof it for further products which lend themselves to the battery electric, fuel cell electric vehicles in the future. So, final summary, from a very strong balance sheet, debt-free, we're very agile to take advantage of any opportunities that come along. We're well positioned within the next generation of truck build, and we're seeing more value add, and our US market is there as a big opportunity for us. So there are some more slides which follow, which are just an appendix for your information, but that finishes the presentation. So I guess Alex will ask for any questions, I think.
Yeah, that's absolutely right, Adam. I will do. So thank you, Adam and Steve, for taking us through those half-year results. Impressive that you've been able to push through price rises with your customers in such tough conditions. I think it's a testament to the quality of the products you're supplying them. So we are now going to open up this webinar to questions. And if you do want to ask a question, please type it into the Q&A box at the bottom of your screen. And just while you're doing that, I'm going to ask a couple of questions which have come in ahead of time. And the first one, Adam, is about the US. Can you talk about the growth of the US business and what you're selling there? And would you consider building a facility in the US?
Yeah, unlike in Europe, where we typically machine the product and finish it and ship it to the OEMs, the supply chain is slightly different in the States, in that the end OEM buys from a machine shop. So we're sending raw castings to America to have them machined. We're typically supplying parts which are in something of a niche, and that's either by design or by the metallurgical specification of them, which seems to be an issue in the States. I mean, they've got very good foundries over there, don't get me wrong, but some of their low volume parts in slightly different materials fit our facility quite well, and make quite a good business for us. In terms of establishing a facility in the States, it is a possibility, and we have thought about, and we'll continue to investigate the possibility of potentially putting some machining facilities in the States, or maybe partnering a machine shop in the States. So hopefully that answers your question.
Yeah, no, that's very helpful. Thank you. And the second question here on, again, M&A, what level of acquisition would you feel comfortable making without having to, I guess, issue equity? And have you found anything that you like out there in the market currently?
I think what we come from is it's a difficult one because it depends on the, on the quality and or the size of what we might look to get involved with. I think, as a straight acquisition, 10 to 15 million from the balance sheet would be quite comfortable for us without having to raise equity. But if the right business came along with the right products and the right end market, and then if we had to raise some equity, we wouldn't be frightened of it.
Okay, thank you for that. Got a question here on capital allocation. Rather than giving regular special dividends, might it not be more beneficial to shareholders in the sense that it would reduce the PE ratio to institute a program of share buybacks?
It's quite a common question, Alex, as to why we distribute excess cash the way we do it. I mean, we have had a go with share buybacks. Did it last year, and we purchased about 70 odd thousand shares. It took us a very long time, and we're just not really sure it's the right vehicle for us. And we haven't got a huge amount of liquidity, although it has improved quite a bit in the last 6 months or so. And to take more shares out of the market seems somewhat counterintuitive.
It's interesting, isn't it? You can't please everyone. And the next question is from an investor that clearly takes a different view. He said, thanks for last year's poor performance and the special dividend. So different views out there on the buyback versus special dividend. But a question here on acquisitions: are you looking to diversify the group or buy something similar to existing activities?
No, if I could make it quite clear, we're looking at two strands at the moment. One is we're working up a plan to put a new production line down in our Drumfield facility, which would add somewhere around 10 to 12,000 tons a year, or 20% more capacity. And we'd much rather put our own iron foundry facility in than acquiring somebody else's. And there are reasons for that, in that the route at which iron foundries take to make their product is often unique to that particular site. And because of that, we'd be uncomfortable taking on board somebody else's processes in our market, and I would much rather build a facility ourselves. So we're through the initial project planning of that, and we just want some more discussions with customers as to see where they're going, and particularly whether, if we put a new line down, can I future-proof it for other products that will come along to feed into the battery electric vehicle market when that starts to grow. If it's something outside of that, it is more likely to be by acquisition, and that would be, for instance, aluminium foundries or whatever, which we've looked at quite a few, and we've had a fair go at a couple, but nothing's come to fruition at the moment. We're still very much in the market looking at that.
Okay, thank you. There's a follow-up question here on the M&A stance, which is: do you intend to remain largely debt-free in the future, even if potential acquisitions arise?
Yes.
That's a very clear answer. Thank you. When you speak to your customers, do you get the impression that they'll be seeking to increase orders through 2023 and 2024? What's the outlook for the market?
The outlook is scarily strong. I mean, we've had to speak with our major customers to actually outsource some product over the last few months, because we just couldn't make enough. Now we got the opportunity to bring that work back in if the work just drop off, but they're forecasting another 10% increase in build rates in the autumn, and there's talk of further increases in 2024. Now I take anything outside 3 or 4 months with a bit of a pinch of salt, but the mood music is all about continuing truck build expansion. What's driving it? it's quite hard to say, other than, I mean, this is me saying this now, it appears that international logistics is more, you know, shipping containers, heavy trucks, warehousing, and then white or grey van man from warehouse to location. And that just seems to be the way it's going. And of course, that feeds into our market quite nicely.
Okay, thank you. Just a reminder to attendees, if you do want to ask a question, please type it into the chat box at the bottom of your screen. Question here on margins. You're talking about volume growth and improvements in demand. Where can margins get back to in the foundry division?
What was the margin last year? What did we look at?
7.1, but that was diluted.
I mean, it's a bit of a, I mean, the energy price will drop in 2024, so our margin will improve a bit bizarrely. But I think over the group as a whole, if things continue as we can see at the moment, we would expect to be back into double figure margins. The heady days of 15 and 16%, which many years ago, because of the surcharging and the commodity increases that have gone and continue to go into the top line of the business, we can't reasonably take a full margin on that expenditure. So that has been margin diluted, but nevertheless, with the further automation we've got going in and the volumes we've got, we would anticipate ourselves getting back to a 10% margin business.
Okay, thank you. And then on the machining division, the machining division seems to have shown good progress again, but why has cash generation in the division gone down?
Do you want to answer that, Steve?
Yeah, I think I sort of alluded to that earlier as well. Mainly around the working capital on those cost rises and the timing of passing those on. And obviously the amount of work going through that business, so it's been increasing in scale, so that naturally has a working capital effect. I would anticipate that, yeah, those outflows wouldn't be expected to be continued in the current year and beyond.
Okay, thank you. And a question relating to, I think, something in the past, have the supply chain problems which disrupted customer orders now been largely sorted out?
Yeah, it was really bad in 21 into middle end 21 into 22 was, you know, we had very disruptive order book challenges. I mean, we had, you know, £1 million worth of sales wiped out for the following week on a Thursday and things like that. It was really challenging. And I'll get to answer the question in a minute, but during that period we were winning a lot of work from Daimler, and we tooled up the Daimler parts on the plants that we were making our main products for the likes of Sky and Volvo, who weren't ordering because of the semiconductor crisis. That's largely behind them, and they started to increase their build rates in the sort of summer, autumn of 22. That caught us a little bit on the hop, and we had to retool a lot of our Daimler products onto other lines to bring the capacity back into place. So since about the autumn of 22, we haven't seen the disruption from the semiconductor market. It would appear that they've resolved it. When I speak to my customers, they'll say that they have very little visibility, so they're a little bit uncomfortable, but they are getting the semiconductors they need.
Okay, thank you. A question here on the currency. Will the stronger pound next year impact your sales to the US and also impact overall profit margins?
Yeah, I mean, we are we appear to be very competitive into the US, undoubtedly helped by the exchange rate. Although I notice it's ticked the other way a little bit in recent times, and yes, it does make us very competitive in the US and helps a lot. We typically either sell in pounds or we have surcharges in place which protect us and our customers from currency movement. So in terms of improvement in profitability, not really, because We have exchange rate mechanisms within our pricing so that it protects us. But of course, if it goes the other way that would benefit us, we don't get the benefit either. If that answers the question.
Yeah, no, that's helpful. Thank you. And we've got one last question here. It's on the pension fund. When are the shareholders going to see the benefits of the pension surplus?
So we're still going through the buyout process. So GMP equalisation is the biggest part of that process that we're having to go through. It is taking longer than we anticipated. I would expect that during the next financial year we should have wrapped that up and be at buyout and wind up of the schemes, and then it's down to negotiation between the company and the trustees on what happens to that surplus.
Brilliant, thank you. Well, that brings us to an end of today's webinar with Castings. Thank you very much for attending. And as you leave today, you'll be asked to complete a short feedback form. We really appreciate it if you could do that. I know management appreciate feedback from investors, so please complete that form. Thank you, Adam and Steve, for such a clear presentation and answering those questions. And just one last thing to remind people that our next webinar is in July. It's on the 20th of July when we have Halma presenting. So thank you all for attending, and we hope to see you all soon.
Thank you.
Thank you.